So, Namaskaram guys. So, this is a chapter that is bank audit, audit of banks. And in CA Inter, what I've observed is that lot of students skip this chapter because they don't understand this chapter actually. So, first of all, before beginning this chapter, let me say something that is we should have an approach to all the chapter which we are studying. So, for this one chapter, you should not learn this chapter like auditing. Around 70% of the portion of this chapter, it should not be learned like auditing. That is the first thing which you wanted to understand. You have to learn this chapter like DT, GST, and law. Basically, like tax, you have to learn this chapter. That is a core thing. If you switch your mind in that pattern, this chapter literally becomes very, very easy. And in this chapter, around 60% of the portions are actually literally easy. So that things are just like simple reading and you will understand that. But another portions are there which you will not understand, which I will simply show. Like, see, these are all things, simple things which you will understand. But when it comes to just wait guys, we are doing a detailed revision of this advances. From here starts the important areas where the question comes for you. Imagine this mode of creation of security. Some students may not understand what is the difference between all this mortgage hypothecation assignment setup. You just need to understand what that is. That's enough. Once you understand, then learning these things automatically comes to your mind. I'll give you memory techniques. I'll tell you what it actually is. Explain everything line by line. These kinds of complicated, complex stuff. Okay. Then this NPA, out of order, overdue. What is the difference between all of these things? What is this thing actually? How this is working in a bank? So when you understand that only, not just a normal revision video. This here I will explain everything how it is happening practically. Because in this one chapter, the question comes literally technical. To understand the question and give the right answer, you need to know what these things are. And once you know this becomes the easiest chapter. Trust me guys, bank audit, it is a tough chapter for you because you are not understanding. It's not because of the length, it is literally that easy. This one video will give you that confidence. I'm guaranteeing you. Only thing I request from you is don't watch it till like mid half and say it is not easy. Like watch it till the end, and then I want to know what you feel. Then if you are not confident, I will take responsibility for that. 100% you'll be confident. That is a guarantee that I have. Like this accounts regularized near balance sheet, what it actually is, how it is working in a bank, because question is asked like that. Then what is advances under consortium, what does it mean, what is consortium? So all those things you need to understand. Then all these are where the technical area. Then how to compute the drawing power, practical calculations, we'll do it with questions, don't worry. So we will focus on the core areas where it is very hard for you to understand, else this chapter revision will take 3 4 5 hours. So we will focus on only the important areas where question will come for next attempt, most high priority areas, plus all the areas where it is difficult for you to understand. Easy areas we'll just, that's simple reading English, you will learn and understand. Okay, so only thing, hold on to this video till the end. Take whatever material you are using, whatever material you are studying from, be it study material, any notes, take it. And if you don't have a material, this is my revised audit book. I'll give this one chapter's PDF in the Telegram channel. The link is down in the description, you can take it. And all the handwritten notes we are using here, I'll give to you for free. So this one chapter, because I want everyone listening to this video to learn this chapter, bro. 5 marks directly, 5 to 7 marks directly you will get. Other chapter standards, complicated question come. This is literally easy. So let's focus. Yeah. So audit of banks. What are the different types of banks? It is literally very easy. Simple reading, you will understand. Then we'll go on to the important areas. So what is engagement team discussion? Before starting a bank audit, we will have an audit team where our audit staff, our like articles, chartered accountants articles, and other experts which are hired by our CA firm will be there. So these are the people who are going to audit the bank. So before auditing, they will have and they are called the engagement team, audit team. They will have a discussion. That is all personnel, all people performing an engagement, including the experts contracted by the firm. Imagine for doing bank audit, we don't know something, so we hired some experts also to do it. So those people, along with our team, we are called the engagement team. So the engagement team will do some discussion. So what are the discussions? These are the discussions. And once these things are discussed, then we need to document it for future reference. Whatever you are discussing, document it in a piece of paper. Simple. So what are included in this engagement team discussion? Whatever things are coming in engagement team discussion. See, what are they discussing about? First, they will discuss about errors that are likely to occur during the bank audit. what are the errors that may come when we are doing the audit. Then errors that are identified in the previous year. Last year, who did the audit? Imagine we did the audit. We say we itself did the audit. So last year when doing audit, what was the errors we identified? So that two things they will check. That is errors. So this is a descriptive area where you have to memorize. So here use just this pic to memorize. I'll give you this PDF, don't worry. So errors that are likely to occur, errors that are identified in previous year. Simple. Then need to maintain a professional skepticism. Professional skepticism means being alert to all the situations. That is having a questioning mind. During the audit, whenever some situation comes, we should have a questioning mind. CA will tell this to the articles and make them remember all these things. Then need to remain alert during the audit. Need to maintain professional skepticism through the audit. Need to remain alert for the informations or other conditions that may indicate a material misstatement. Then what are the methods by which fraud would have been perpetrated by the bank personnel? That is, when we are discussing, we'll discuss, okay, in which all methods bank people may do the fraud. We'll have an idea, like before checking itself, we'll have an idea in which all methods they may do it. So while checking, it is easy. Then auditor's response to the engagement is pervasive risk and specific risk. It's that simple. So what do you actually mean by this? Because guys, we have to learn it like this. Engagement is pervasive risk, specific risk. What do you mean by this? That is my question. Engagement risk means any risk to the auditor's reputation. That is, imagine I'm going to audit Baiju. Baiju is a bad company now, so I will also lose my reputation. So similarly, if I'm going to audit a bank, will anything happen to my reputation because of that company, bad bank I'm auditing? That is engagement risk. Because of that engagement, what is a risk applicable to the auditor? Then pervasive risk. Pervasive risk means any risk that will affect the entire financial statements, that will affect many things in the financial statements. Example, company had a weak internal control. So when the internal control is weak, lot of mistakes or errors or fraud can happen, and company's financial statements, many areas it can go wrong. So such a kind of risk, such a kinds of errors, chances are called pervasive risk. Then specific risk. Specific risk means any risk that is tied to specific areas, like loan area. What is the risk tied to that? Those things. So just understand this much. Enough. So this is the pictographic way to remember this. Not use a mnemonic, just use this picture in mind. Then next, what are the advantages of such discussion? Very easy, just learn it simple. Then upon this is what we learn to focus, like income recognition policy, we will learn it. So just I'll give you a brief. Income recognition policy. If it's a performing asset means what is an asset for a bank? What is the process of a bank? Bank will take deposits from customers, that is people, and they will pay say 7% interest, and they will lend this money to people for like 12, 14, 15% interest. So that interest gap is their income, main income. So this loan given by the bank, called the advances given by the bank, those are what we call an asset for the bank. It is an asset because it is helping bank generate income. So two things are there called performing assets and called non-performing assets. Performing assets means any loan given by a bank and the repayment is basically regular. Repayment every month, proper EMI is coming. So that is what we call a performing asset. What is called an NPA? If the repayments are not regular for 90 days plus, there is no receipt. Like last 3 months, I have given a loan, but that person has not repaid for the last 3 months. Basically 90 days he have not repaid. So then that account becomes, in the bank's booklet, that personal account becomes NPA. Simple as that. Okay. So in regular payments, if properly payment is you are getting like EMI, everything is coming proper, then income from that is the interest component you receive from that loan, that is recognized on accrual basis. That is whenever it becomes due, bank can recognize that as income. There is no need to wait for the receipt. Whenever on 15th of every month interest becomes due, 15th itself they can recognize the income. Then the money is received only on 20th, but still 15th itself they can recognize income. Learn it like this, then bank is easy. So because this is regular payment, every month is coming properly, so you can do like that. But if an account becomes NPA, you gave a loan, he is not repaying, so his account becomes NPA. In bank's booklet, we just classify it to NPA, that's it. Nothing else is there. So in that case, you will not recognize income on accrual basis because he is not even giving the money. So how can bank recognize income on accrual basis? No. So what will bank do? Bank will recognize income only when he is actually paying. That is when he receives 15th of every month interest is due, but bank will not recognize income on 15th. He will recognize it only on when the income is received, when that EMI is received. So that is the difference between performing and NPA. Then we will deep focus more on that later in the here itself. Then appointment of the auditor. First question, let me ask you something. Is SBI, State Bank of India, you know that, right? Is it a nationalized bank or not? Is it a nationalized bank or not? Everyone will say yes, but it is no. This is just a general info I'm giving you. SBI is not a nationalized bank. So, because there were some rules, like it was started before nationalization, some other rules are there. Because of some reason, this SBI is basically not a nationalized bank. Then auditor of a banking company, that is companies which are banks like ICICI, HDFC, all these are basically companies. They are banks, but they are incorporated as companies. Their auditors are appointed at the AGM of the shareholders of the company. And approval of RBI is required for appointment. The auditor will be appointed at the AGM, then approval of RBI is also required. Then auditor of a nationalized bank like Indian Overseas Bank, Bank of Baroda, all these are nationalized bank, not SBI. Their auditor is appointed by the bank itself through its board of directors of the bank. Okay, approval of RBI is also required. Then regional rural banks, it is to be appointed by the bank concerned with the approval of central government. Okay, yeah. Then, remuneration of the auditor. Remuneration of auditor of a banking company. It is banking company. This one's it is fixed as per the provisions of 142 of Companies Act, and remuneration of nationalized banks and SBI. If it was nationalized bank, why should we give it separately? It is fixed by RBI in consultation with central government. You have to keep. We are only focusing on important areas for question. If you just watch this revision and learn whatever I am saying, whatever I am teaching, 100% you will get the marks. So invest this time. Don't just think like, why should I invest my time? Invest your time, because then only you can get something. Anything that is big, bank audit is a big chapter. Learning it takes time. So invest the time. Then powers of auditor, you have to just very easy, chumma read and leave. Then auditor's report, this also is very easy, just read. But this kind of question can come, but it's very easy. I am not explaining. Then LFIR, just read LFIR every. It's just a report which should be given along with bank audit report. Simple. Just understand that much. So, all these things will be mentioned, and here statutory central auditors has to submit LFIR to the bank by 30th June every year. This date is an MCQ important. Then conducting an audit, lot of things are there, bro. Don't sit and try to memorize everything in this. That is not needed. Whatever I'm saying, just study that. Okay. Initial audit considerations, MCQ chances and descriptive chances area, I will tell you. First is declaration of indebtedness. That is how to do a bank audit. Before starting the audit, before appointing the acceptment, before accepting the appointment, auditor should submit something called declaration of indebtedness. That is, auditor should not be indebted to the bank in any way. He should not have taken any loan or anything from that bank. Then, internal assignments by the statutory auditor. That is, internal auditor should not be statutory auditor. Same thing. And planning is very easy. Then communication with the previous auditor, very, very important. It simply means communication with previous auditor. If I am going to be appointed as auditor of, imagine, Indian Overseas Bank, last year audit was done by another person. So current year I am the auditor. So before starting the audit, I need to communicate it with the previous auditor. I need to call the previous auditor or mail the previous auditor and say, sir, I am the auditor of current year. Do you have any objections? Because sometimes last year the auditor would have done the audit and bank would have not paid him the fees. So he has an objection, right? So similarly, any problem is there, because this one rule is kept to protect our CA community. Else the clients will not pay the fees or all these things. So we will call the previous auditor, tell him I am going to be the auditor. Do you have any problem? Do you have any objection? He'll say, no, sir, no objection. Everything was good. Then we'll say, sir, please give a NOC, non-objection certificate. That is, please write in a paper that you don't have any objection and give it to me, that you have received all the payments, everything. So he will give you an NOC. Very, very important. A descriptive question can also come. Communication with the previous auditor. A chartered accountant in practice cannot accept the position as auditor previously held by another chartered accountant without first communicating with him in writing. You have to do, not through a call, writing, you have to send him a mail or something that I am going to be the auditor. These things. Normally, you can give a call also if you have the number. He should get a new auditor, should get an NOC, non-objection certificate from the previous auditor through his communications, and know whether he has any objections to such appointment made for any valid reason. Invalid reasons alone just ignore. Valid reason, like he is saying some objections, okay. You have to consider that. Then only start the audit or accept the appointment. Simple. Then these are all things are very, 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 very easy. The normal, you learn it in the first and second, third chapters. All these things very easy. 315 ella. Chumma just read and leave. They are not gonna. I don't think they'll ask questions from that area. So this is another area where the question comes. Understanding the risk management process. Every bank is the most riskiest business, right? They are managing this much people's money. So when they are managing this much people's money, a hacker can hack into their system. So to protect that, they will have a risk management process. So this risk management, they will have a team or they'll have some softwares to do this. So as an auditor, it is your responsibility before starting the audit or during the auditing, understand what are the risk management process of the bank. What is the risk management process? What are the softwares or people they are using to manage the risk? An effective risk bank management develops controls and uses performance indicators to aid in managing key business and financial risk. An effective risk management system in a bank generally require the following. For an effective risk management system, these things are needed in a bank. So as an auditor, just see all these things. Just understand bank's risk management process. So first, to make that risk management system effective, the risk management system should have a oversight and involvement in control process by the TCWG, those charged with the governance, board of directors, MD, all these people. It should approve the written risk management policies. That is all the risk management policy. The board of directors, those charged with the governance, those people should have an oversight. That is, they should have a supervision over these policies. Because don't let the management alone decide everything. No, these people should agree it. That is an oversight. Then that is O. O, ICMR. ICMR, you know, right? Indian Council of Medical Research. Simple. Then, or you can think like O and I, oversight and involvement in the control process. Then by TCWG. O and I, OICPT, or you can learn it like this. Then identification, measurement and monitoring of the risk. That is, risk that could be significantly impact the achievement of bank's goal should be identified, measured, monitored as against the pre-approved limit and criteria. All the rest should be measured. IMM. Identification, measurement, monitoring. Then all the control activities should be there in a bank. Bank should have proper internal controls and control activities to mitigate its risk, like giving segregation of duty. Every duty should not, all the power should not be given to one employee. You should give it to different employees, so that else this one employee itself will do the fraud. So give his duties to other people. Split the duties and give. That is called segregation of duties. All these things you need to have. Then monitoring activity should also be there. Risk management models and methodologies and assumptions used to measure and mitigate the risk should be regularly assessed and updated. That is, what are the monitoring techniques bank is using to measure its risk, to monitor whether the risk, everything is done properly. So the risk management models will be there, methodologies will be there, and assumptions will be there. You have to check whether they are properly assessed and updated. Then reliable information system. Bank requires reliable information system that provide adequate financial, operational and compliance information. This is literally a very just memorization point, the head points and with the keyword one point. So here nothing is there to understand, just study and leave. But the conceptual areas I'll sit and explain in depth, so that you need to understand. Next is this one, audit planning memorandum also you study. Then these things, 240 and like this, just read and leave, that's enough. Then this is one important thing, what is called stress testing. Stress testing is a software testing activity. So this stress testing means when you are testing a software, that is, a software is saying it can handle only 1000, but you may put 1200 data and see whether it can actually handle that much stress. So even though they're saying the software can handle 1000, software may be able to handle a bit more extra. They would give that buffer, right? Same thing, same concept is called stress testing. That is bank's software testing. That is, important softwares, mission critical softwares will be there in the bank. You will test that software whether it can handle more stress, that is more data at a time. So stress testing is a software testing activity that determines the robustness of the software by testing beyond the limits of normal operation. Normally, that software can handle only 1000 customers at a time. But we'll put 1200 customers just to see whether that can, any days if some extra demand comes, whether that software will collapse. To check that, we are just testing the stress of the software. How much stress, how much extra data can the software handle at a time? That's it. Simple. So it is basically done for the mission critical softwares. Simple. Then these things just read very, very easy. Then advances. Here starts the most important area of this chapter, that is advances. Advances are the more important area. We'll focus here more. So what are advances? Advances are basically money or credit given as a loan from a bank to another party. That is, any loan given by one bank to a customer is called advances, and it is an asset for the bank. Okay. What are the different types of advances? It is called funded advances and non-funded advances. Funded advances means money, actual money that you are giving to a bank, giving to a customer. Bank is giving a loan. Actually, money is giving, that is called funded advance. Non-funded advance means here you are not giving any money to the bank, but it is basically like giving money. Example, you are giving a guarantee for a customer. Imagine I am a customer and I needed to buy 1000 units of raw materials from a supplier. So and supplier is somewhere in the China supplier. Bank that China supplier we can call and tell him, sir, give me 1 month credit. This SBI bank is going to give you a guarantee. That is, even if I don't pay it in the next 1 month or 2 months, SBI bank will pay you. So bank is basically giving a guarantee. So China supplier should not trust us, but he can trust a bank because they are writing and giving to him. So that is called a bank guarantee. So the China supplier will give us on credit, and within 2 months we will pay it. And if you don't pay, bank will pay, and bank will recover it from us later. So this is called a non-funded. Here bank is not giving any fund to us, but basically it's just like giving the fund itself. It's just like giving us that loan itself. So that is called a non-funded advances. Actual transfer of fund from the bank. This one funded, like here, which do not involve actual transfer of fund. Example, bank guarantee, giving letter of credit, all these things. Hope you are understanding. Okay. And whenever you are like, we are going very quick. So whenever you find it over like too much in your head, just pause it, take your book, read it, then resume. Okay. Then what are the different kinds of advances? Different types of loans. Different types of loans, what are they? First is called term loans, which you give for a particular number of years. 5 year, 3 year, 10 year. The term is there. Fixed term is there. That is what we call a term loan. Then next is called cash credit, overdraft, and demand loans. This is basically for financing the working capital of a business. Bills discounted and purchased, participation on risk sharing basis. This is also another kind of a loan, that is another kind of advance that bank is giving to us. Then interest bearing staff loans, giving like loans given to the staff, with bank staff with interest. So these are things. Then disclosure, everything just read and leave. Then classification of advances. How can you classify the advances? Divided, that is through sector wise and through security wise. That is, imagine I'm a bank and I'm giving a lot of loan. I can classify it based on sector. That is, all the loans that are given to priority sectors like agriculture, education, etc., and all the loans that are given to companies which are not in the priority sector. You can classify it, all the loans, either like this, sector wise, or you can classify it based on the security wise. Security means all the loans, like when a bank gave you loan, you will give a security to the bank, either your property, land or building, other title deeds you will give. So all the loans that are given by the bank by taking a security, that's one set. Second set, all the loans that are given by bank without security. So you can either classify it like this or like this also. The nature of the security, different types of securities are there. First is called a primary security. Second is a collateral security. You are taking the loan for the first time. Imagine, I will give you a hypothetical example. The difference between these two. I wanted a 50 lakh loan and I have one property. That property's value is say 70 lakhs. So I gave the title deeds of property to the bank and I took a 50 lakh loan. Done, no problem. Bank is happy. So that security is primary security. Now after 2-3 months, I needed another or 10 lakh loan. So then I approached the bank. I told the bank, sir, my 70 lakh property is with you. You have given me only 50. And can you give me extra 10 more lakhs with the same property? Bank will say, no, sir, because we need a safety margin. We don't know what will happen to your house and your house. So we cannot give you extra 10 more lakhs. We can give you maximum 5 lakhs. So if you want 10 lakhs, give me some other security also. So I will go, I will have some gold or something with me. I will give that also to the bank. So, and I will take another 10 lakhs. So that is the extra security you are giving for the same loan. Extra security, that is called a collateral security, is additional security. Security can be in any form, tangible or intangible asset, or movable or immovable asset. Okay. So the next is mode of creation of security. How do you create a mode of creation of security? For that, I will show you a chart. And I'll give all these things for free, don't worry. If you go to my Telegram channel, in the description, lot of these kinds of free notes are there regarding Caro. My previous video regarding Caro, in 20-30 minutes, entire Caro clauses in one mnemonic I have mentioned. Just go and watch that. Your Caro will be sorted 100%. You'll never forget the clause. So this is mode of creation of security. That is, how can a bank create security? First, through mortgage. Mortgage means you are taking a loan, pledging your security, right? So mortgage is something that is applicable for immovable property. If you are giving any immovable property like land or building as a security, that is what we call a mortgage. Using an immovable property as security for loan. So types, there are registered mortgage and something called equitable mortgage. Registered mortgage, you will sign a formal mortgage deed with the bank. Because here, equitable mortgage also, I'll say, wait, registered mortgage, you will enter into an agreement with the bank. An agreement, the stamp paper, all these things will be there. In that, you will enter into a deed with the bank, and that is registered with the government. Registrarly, it is registered. That is called a registered mortgage. In that, you will, so the bank will have the legal right. So that is called a registered mortgage. You are registering that loan, registering that mortgage, that is property you are pledging to bank. You are registering that in the bank's thing through that this stamp paper and all these things. That is registered mortgage. Equitable mortgage is the things which you have seen in the movies and all these things. Like no agreement, nothing is there. You have a home, you have like the title deeds with you. You will just go to a bank and give this title deeds. You take this title deeds, give me 10 lakh. When I repay it, give me the title deed back. Done. No agreement, nothing is there. So here you are just giving the title deed, but here you are lending through the agreement through this registering. You are registering that agreement with the government through registrar. But here also normally banks will take the title deed also. Actual practice here registered, here the bank will also take the title deed also of you. Here basically it is actually in real practice the title deeds will be there. Title deeds they will take you, plus they will enter into this stamp paper and all this registered will be there. Here only title deed is there, no register, nothing is there. Okay, no agreement, just give the title deed and take the money. Old style thing which you have seen in the movies. Okay, yeah. So then next thing is called pledging. What is called pledge? Here I told you we need to know the difference between each and everything, because the question comes, you have to identify whether they are asking about mortgage, pledge, whatever it is. So for that you need to understand what these things are. So mortgage is basically for immovable property. Pledge is for basically movable properties. See, borrower gives his goods to the bank as a security. Goods is a movable thing. That imagine I have a gold. I'll give the gold to the bank and taking loan. That is what we call pledge. Ownership is still with the pledger. I gave a gold to the bank, but still the ownership is with me, but the possession is with the bank. Okay. Bank has certain rights only, example gold loan. Next is hypothecation. This is basically the car loan thing. That is, this is also a movable item, this is also movable, this is immovable. Okay. Here in this case, you are giving your gold as a security. The possession is with the bank. But in hypothecation, possession is also with you. But bank will only have a right. Imagine you take a car loan and that car is actually yours. The car is with you, possession is with you, ownership is also with you. But bank has a right over it. That is what we call hypothecation. But in gold loan, the ownership is yours, but the possession is with the bank. That is what we call a pledge. So the ownership and possession is a differentiating factor. Similar to a pledge, but you don't give physical possession of the goods to the bank. You are not giving physical possession. Car is with you. Both the possession and ownership is with the borrower itself. Done. Example, car loan. Or example, stock hypothecated and overdraft taken. That is, I have some stock in my warehouse. I hypothecated it and I am taking some loan. Simple. Then next is assignment. Assignment means you have a right to receive something. Imagine you have a policy, life insurance policy or something. So that is your right to receive money on the maturity of the policy. So anyways, imagine you have a life insurance policy of 5 years and today is like next week it is maturing and you are going to get money. So now urgently today you need a 10 lakh rupee. The life insurance policy is of 10 lakh rupee. So what you will do? You will go to the bank, give the life insurance policy to the bank, and I will tell the bank, we'll assign the right to receive money. This was my right to receive money from the policy. I will assign that right. I'll give that right to bank and tell the bank, you take the money, but now give me 9.5 lakhs. Like 50,000 you take it as your commission. Like the now giving me. Like that is what we call assignment. Transfer your rights in something to the bank and give loan. Bank will give you a loan. Or like, sorry, life insurance policy, that is another case. One more thing you can keep in mind. Like you wanted a loan and you have a life insurance policy with you. Life insurance policy is 10 lakh. You will go to the bank, give this life insurance policy to the bank, you will transfer that right to the bank and the bank will give you 9.5 lakh loan. 10 lakh policy you have given to the bank. Okay. So here at the maturity date, the life insurance policy will pay the money to the bank. So before that, if we repay the loan and we can take that life insurance policy back also. Before that, if we repay the loan. Okay. That is what we call assignment. That is life insurance policy transferred to the bank and taking loan from that. Normally, life insurance policy, okay, that you, what does it mean? Then next is called, what happened? Okay. Wait, Then next is what I call a set off. Set off means bank has a right to use your money to pay off your debts. That is, imagine you have an FD with the bank and you have taken a loan also, but you are not repaying the loan. Bank can set off that loan against your FD. They have that right. That is what we call setting off your debit towards your credit. You have any deposit. Then lien. Lien means legal right to keep someone's property in your possession until they have repaid. Imagine you have a car and the car is wanting a repair. You give to the workshop and told the workshop guy to repair it. And the workshop guy repaired it and told 3 lakh rupees is the bill or 30,000 is the bill. So now till you pay him that 30,000, that workshop owner has the right, the lien to keep your car. That is what we call a lien. Okay. So your bank case, you can think your valuable documents are there in the locker. Now if you don't repay what you have owned, bank has a lien for that document. Simple. You have some valuable documents in your locker and you have taken some loan also. If you are not repaying, they have a right, they have a lien over that document. They can keep it till you repay. Practically how much happens difficult. It is different. Yeah. So understand, I hope you understood mode of creation of a security. So yeah, prudential norms on income recognition, asset classification and provisioning. So this is the most conceptual area of this one chapter. One second. Yeah. So the first thing you have to understand is NPA. What is non-performing asset? A loan given by a bank to a customer and the customer has not repaid to the bank for 90 plus days, it is termed as NPA. This is for a normal loan, normal term loans. Other categories are also there. An asset becomes NPA when it ceases to generate income to the bank, when it stops to generate income. That is the point at which asset becomes NPA. When EMI is not receiving, bank is not getting interest. So that asset, that loan given, ceased to generate, stopped to generate income for the bank. So NPA for normal loans given, interest or installment of principal remain overdue for more than 90 days, this has not been received. That is what we call for normal loans. Then for overdraft and cash credits, accounts remains out of order in respect of overdraft or cash credit. What is out of order? Here it is. So for overdraft and cash credit, if the overdraft or cash credit account remains out of order, we learn what is out of order. When it becomes out of order, then automatically it is classified as NPA for overdraft. For loans, 90 days limit is there. Then for bills purchased by the bank has purchased a bill from someone and imagine that a receipt date is next month the 15th. So the bill, if it is not received on the next month the 15th, the bank has not received that money, then that is it became overdue. Then if it is overdue for more than 90 days, then it is called as an NPA. Receipt date is 15th and 15th it has not been received for the next 3 months also, 90 days also it is not received, then it is automatically called NPA for bills. For three things, classic different types are there. For loans, this is the limit. For ODCC, this is the thing, and for bills, this is the limit. So what do you mean by this out of order? Before that, let's see what is overdue means. Here, interest or installment remains overdue for more than 90 days, right? And here bills also overdue. What is this overdue? Overdue simply means on the date of payment, the money, on the date of actual money to be received, that date money has not been received. That is called overdue. Any amount due to the bank under any credit facility is overdue if it is not paid on the due date. Due date is 15th. If it is not received by the bank on 15th, it is called as overdue. And it is overdue for more than 90 days. That is not received for more than 90 days from that date, it becomes NPA. Then what is out of order? The outstanding balance remains continuously in excess of the sanctioned limit or drawing power. Imagine the sanctioned limit for the loan. We learn all these things. Sanctioned limit is say 10 lakh and drawing power is say 8 lakh and they not 8 lakhs, let's put it 9 lakh, and the customer has withdrawn amount like say 8.5 lakhs he has withdrawn, but he has not repaid, so the interest everything accumulated, and now 8.5 lakh is almost like 9.8 lakh or 10 lakh or 11 lakh. So the outstanding balance is, imagine 11 lakh with the interest, all these things. This is now this 11 lakh is more than sanctioned limit or drawing power, right? So then it is called as out of order. This is for cash credit and overdraft. They have purchased, they have taken the money, but if it is not, if the outstanding balance is in excess of overdraft and in excess of sanctioned limit or drawing power, it is called as out of order. So when it becomes an out of order, it is automatically called a NPA. Imagine sanctioned limit is 10 lakh, drawing power is 8 lakhs, and the total the loan they took was 7.5 lakhs. So first case, outstanding balance is 8.2 lakhs. So outstanding balance is greater than drawing power is only 8 lakhs. Outstanding balance is 7.5 lakh plus all the interest everything accumulated, and now it became 8.2 lakhs. Outstanding balance is greater than drawing power, so it is classified as NPA. Second case, in cases where the outstanding balance in the principal operating account, outstanding balance, this one, is less than the sanctioned limit or drawing power, but there are no credits continuously for 90 days. That is second case is This outstanding balance is less than drawing power and sanctioned limit. Imagine it is only 7.8 lakhs. So it is less than this too. But for the last 90 days, no credit, no receipt has been received from that loan given. No EMI, no interest, no e-principal, nothing is received. Then we call it as a out of order. So when it becomes out of order, this is only for cash credit and overdrafts. So when it becomes out of order, it is automatically classified as NPA. That is this one. No credit for the last 90 days. So you don't have to read this much. Just write this on your side. It's enough. You will understand. Then credits are there. This is the first case is this. In this case also it is NPA. If this case is also NPA and this case is also NPA. That is this case is out of order item, then it becomes NPA. Credits are there, but not enough to cover the interest debited during the same period. Credits are there. That is, imagine outstanding balance is 7.8 lakhs. Imagine. So, and in the last 2-3 months, payment has also been received. So, if outstanding balance is more than this, automatically out of order. If outstanding balance is less than this, but no credits for 90 days, still it's out of order. But if outstanding balance is less than this, but credits are there. Credits means the customer has paid some money, but that money is not even enough to recover the interest portion. Imagine this was the initial loan taken, and along with the interest, the outstanding balance became 7.8 lakhs. So this is less than this too. And the customer over the last 3 months paid amount almost 25,000 he paid. What is the interest component itself is 7.5 to 7.8 is 30,000. So the money the customer only paid this much. EMI was way more than this, but he only paid this much. Here the credit given by the customer is not even enough to meet the interest portion. Interest is 30k. It is not even enough. So in these 3 cases, we will call it as out of order. Credits are there, but are not enough to cover the interest debited. So hope you understand. 7.8 lakh was outstanding. Repaid only 25,000 in the last 3 months. So interest itself is 30,000. This credit is not even enough to cover the interest. Done. Hope you are getting the clarity. That example they have written it here. Overdue we learned. Now we will focus on the categories of non-performing assets and provision. And provision, that is, for a bank, loan given is an asset. So when you are not receiving money from an asset, or when you know that that person who has taken the loan, he is not having any money, or he is having any bigger issues, if he is having some bigger issues, what is the thing? Bank has to put a provision, just like debtors. Normal for companies, debtors, we will put a provision. Similarly for bank also, if you think the money is not going to come, we need to put a provision. Okay, so we are learning about that provision now. So first is, if it is a substandard asset, normally when a bank gives a loan to someone and the money is properly being repaid, it is called a standard asset. For standard asset, no provision is needed. In inter, you are not learning, but finally it's like 0.4 general provision are there, leave it. So if the money, everything is coming properly to you, properly everything is, they are repaying it on time every month, no problem, no NPA, nothing, then it is called a standard asset. That loan is a standard asset and you don't need a provision for that. But if that asset became NPA, that is if that loan became NPA, and NPA, imagine the date they became NPA today. From that date till 12 months, you are classifying that as substandard asset. You will classify it as substandard asset, and substandard assets require 15% provision. Then doubtful assets, if it is a doubtful asset, that is it remained in the substandard category for a period of 12 months plus. That is till first, the moment it became NPA, for the next 12 months, it is called a substandard. The moment 12 months are over, from the next date is called as doubtful asset to 1, D1. For that, we will put a provision of 25%. If the loan is secured, that customer has given some security, in that case, we will put 25% provision. If the loan is unsecured, no security is there, we will put 100% provision. Doubtful up to 1 to 3 years. 1 year and doubtful is also over. Then the next second year to third year onwards, you will put basically 2 to 3 years, you will put 40%. Unsecured 100% provision. And doubtful over, if the last 3 years our money has not been completely remained in NPA, 1 year has been over, so it became doubtful 1. Then 2-3 years are over. Then the third year, if it is more than 3 years our money has not been received, you will put 100% provision. Done. Hope you got it. So you need to know provisioning. So in the first year, if you are putting 15% provision, second year you need to put 25% provision, but already 15% has been put, so extra 10% extra, only you need to put current year. The next year you are putting 40% provision, but already 25% is done. 15% in there you put, and another 10% you put here extra. So now almost 25% provision has been put. In the third year, if you are putting 40% provision, that means another extra 15% you have to put in this year. Then in the third year, extra already 40% has been given in the previous year. So an extra 60% amount you put it here about the for the outstanding balance. Then loss asset. A loss asset. Loss has been identified by the bank or internal or external auditors or RBI inspection team, but the amount has not been written off fully. If it's a loss asset, that is, if the RBI has considered that advance as a loss asset, then you put 100% provision. Simple as that. For advances, for a loan given by a bank, three things are there. Income recognition. We need to learn the rules regarding income recognition. That is whether that asset becomes NPA, how to recognize income from the bank. That is on, if it becomes NPA, we need to recognize income only on accrual basis and only on receipt basis. I told you. Then asset classification. When that asset becomes an NPA, if that asset becomes NPA for less than 12 months, NPA item, but 12 months are not been over, you classify it as substandard. Then if it is more than 12 months, then like this. This is assets classification we are learning. Then we will also learn regarding the provision. That is, this provision depends on asset classification. When an asset is classified as substandard, this is a provision to give. Like that, provision also. Three things we are learning regarding a loan. Understand, these are three separate things: income, asset classification, and provisioning. Okay. Then classification of NPA should be based on record of recovery. That is basically if you have not received the money for the next 90 days, last 90 days, then NPA. Then one more thing you have to keep. Imagine Adani or Ambani has taken a loan from a bank. So we know that a bank also know that Ambani and Adani are very rich people. They have a lot of money. They have given a lot of guarantees and securities also for the loan. But if they have not repaid the loan for more than 90 days, still it becomes an NPA. How much ever rich they are, how much ever whatever they are, still if money is not received for 90 days, whatever guarantee they have given, it is still classified as NPA. Remember it for MCQ or descriptive questions. Another most important thing you have to understand is asset classification. That is asset classification. This one, classification should be borrower wise and not facility wise. That is, if I have taken two loans from a bank, a home loan and a car loan. Imagine I paid all the home loan EMIs on time. Every month perfectly I have paid. But car loan EMI I have not paid on time. So car loan EMI is like 90 days I have missed. I have not paid any EMI. So car loan account will become NPA? No. If car loan accounts becomes NPA, that person's all the account is treated as NPA. Even though he is paying home loan properly on time, still his home loan also becomes NPA. All his assets, all the assets means all his loans, that is for a bank it is asset, all his loan will become NPA. So and classify all the loans based on this. Okay, so understand, that is the example given. A car loan as well as a housing loan from XYZ Limited. He is regular in depositing housing loan EMI, but not deposited the 4 EMIs of the car loan. That is 4 EMIs, 4 months missed, 3 months, 90 days mele. Then due to the positive funds. Hence, in this case, not only the car loan but the housing loan should also be treated as NPA, although it is going really good. So NPA classification is borrower wise, Mr. Remans, that person wise, not the facility, not the car loan or housing loan individual facility wise. Keep in mind, very, very, very important. So next is this one called accounts regularized near the balance sheet date. So here, guys, understand first thing. This NPA classification, bank does this NPA classification on a regular basis. That means imagine a bill on September, a customer started not paying. Customer is not paying from September onwards. So September, October, November, 90 days he has not been paid. So on November, his account becomes an NPA. In bank's book, from November onwards, that is imagine from November 30 or December 1st onwards, that account become NPA. 91st day onwards, it becomes NPA. And it is continuing to become NPA. Customer has not paid any money. Okay, November, December, January, February, March, it is becoming NPA. And at the closing, the balance sheet date, 31st March, that accounts, that customer's borrower's account will be classified as NPA. So what these borrowers do is, if an account actually becomes NPA, imagine Adani is not paying and Adani's account become NPA, it is a very bad remark for Adani. Adani's credit rating will go down. He may not get another loans from other banks. All these issues are there. So on 31st March, Adani don't want his account to become an NPA, to be shown as an NPA. In the balance sheet, it will come Adani's account as NPA. So to avoid that, what Adani will do, just before 31st March, imagine 5 crore is the outstanding amount. 5 crore is the outstanding amount. If Adani pay 5 crore, imagine the total loan is there 15 crore. But if Adani pay 5 crore, 15 or 150 crore. But if Adani pay 5 crore, his account will be changed from NPA to normal regularly, it will go. So on this is 31st March. This is 31st March. Understand? This is 31st March. So just before this date, that is almost say March 15th or March month. What Adani will do is, Adani will come to the bank, Adani will get money from somewhere else and Adani will put 5 crore rupees to the bank. So what happens immediately, NPA, the account of Adani which was NPA, now it changed to regular. So March 15th he put this money, March 15th or 25th he put this money. And what he will do, he has a good tie-up with the bank manager. So after this 31st March, that is April first week, the bank manager will give another 5 crore rupees to Adani, like a loan, another loan or something. He will give this back, this 5 crore to Adani. So basically, Adani put 5 crore from somewhere, and after 31st March, he is taking it out. So what is actually happening on 31st March on the balance sheet? Adani's account is not NPA. So Adani is saved. So these kinds of fraud kind of a thing, these borrowers and bank managers together, they may do these kinds of things. So to avoid this, as an auditor, it is our, because this is what we call account is, that is Adani's account is regularized from NPA, it is shifted to regularized at the balance sheet date. Adani's account is regularized at the balance sheet date, not from escape. That is basically he escaped from becoming an NPA. He escaped from the NPA category on balance sheet date. So this is what we call account regularized near balance sheet date. So as an auditor, it is our duty to check, while we are auditing a bank, we have to check whether these kinds of any fraud issue is there. That is what we call account regularized near balance sheet date. Asset classification of the borrower account where a solitary or a few credits are recorded before the balance sheet date should be handled with care without any scope for subjectivity. That is, solitary means one credit or a few credits, 3 or 4 more credits, money is coming to this. That is, this like money is coming. We have to check whether any money has just come before the balance sheet date and that same money is taken out after the balance sheet. If something is like that, then it may be to avoid escaping from the NPA classification. So these kinds of fraud these borrowers and bank will do, we have to check that. So if an account indicates these kinds of an inherent weakness, it should be deemed as an NPA. Then auditor should check, he should take some accounts, like some accounts on sampling basis and check for these things. Okay, just to see that whether any money has come in and the same money has been reversed after the end of the financial year. Same thing is written. So understand these kinds of things like this, practically how is happening. So it will be very easy for you to remember and study also. Because there nothing. Now tell me, bro, is there anything to study? You understood everything in your mind. Now just with these keywords, that is sample transaction, he will take inherent weakness, then it should be classified as NPA, classification of borrower, that is solitary or few credits. Just these words you need. With this, you will be able to frame sentence because you know the concept. That is why this lecture is all about. Then government guaranteed advances. That is, any loan, I have taken some loan, and for me, government is giving a guarantee to the bank that if Sudarshan doesn't pay, government will pay. So in those kinds of loans, what should an auditor do? If it is guaranteed by the central government has given the guarantee. Okay, where guarantee is not invoked, that is, guarantee has not been taken back by the central government, or I'll simply say, if the guarantee is given by central government and it has not been taken back, the asset classification, and you are not paid the money. Imagine such kind of I have taken a loan from a bank, central government guaranteed, and I have not paid the money to the bank for more than 90 days. It becomes like an NPA, like 90 days I have not paid. In that case, what to do? If it is money, everything is proper, nothing, normal classification, you go. But if money I have not paid it for 90 days, what should do? Asset classification, you don't need to change it. Even though it became kind of NPA, you should not change the asset classification because central government is the guarantee. We can blindly trust, bank can blindly trust. If I don't pay, central government will pay. So asset classification, even though it becomes NPA, it should be standard itself. Then income recognition for that loan, for my loan I've taken from bank, income recognition, it is based on NPA wise itself. That is, if account becomes NPA, 90 days I have not paid, income should be recognized on normal receipt basis only, no accrual. But for provisioning, you don't have to put any provision also, because provision is dependent upon classification. Which classification comes? If the asset is substandard, then this provision comes. If it is doubtful, so this will come. So provision is dependent on asset classifications, right? Since here asset classification is not changing, even though asset becomes NPA, still it is standard, so no provision is also required. Then state government guaranteed advances. If the advance, I have taken a loan from a bank and state government has given the guarantee, this is just like how a normal loan will be. Nothing special treatment is there for state government. That is, if it becomes overdue for more than 90 days, asset classification will come. That is standard, substandard, doubtful, everything will come. And income recognition is just like normal. That is, if it becomes NPA, then income recognition on receipt basis, then provisioning also will be required. That is, depending on the asset classification, you will put provisions. If it is substandard, then 15, doubtful one, then 25, D2, then whatever, the 40%, all these things. Okay. So next is advances under consortium. Advances under consortium. Consortium means a group of banks coming together and giving a lending. Imagine, like I'll give things with examples, so exam when question comes, it will be very easy for you. You will be able to write the answer. Advances under consortium means, imagine I am a businessman and I needed 1,000 crore rupees to construct a shopping mall. So when I went to SBI is saying, sir, we cannot give 1,000 crore rupee, maximum we can give is 300 crore rupee, 300 crore. So what can we do is, we will talk with ICICI and HDFC, and together we will form a consortium and together we will give. I will give you 500 crore. ICICI will give you 300 crore and HDFC will give you 200 crore. So these three banks forming a group, that is forming a consortium, and they are giving you loan. So three banks, small amounts they are giving us loan. For you need 1000 crore, that is given by SBI 500 crore, HDFC 300 crore, and Bank of Baroda will give you 200 crore. This is what we call advances under consortium, giving loan by all the banks, by some banks forming a group consortium. So here SBI is the major loan giver. Bigger amount is given by him. So he is called the lead bank here. SBI is called the lead bank. And I will have my terms and talks with SBI more. Even though these people are included, initially after agreement everything, I will meet these people. But after that, my payment everything will be with SBI. Imagine the total EMI for this is say 5 crore per month. Imagine 5 crore is the EMI. What I will do, I will pay this 5 crore directly to SBI. And SBI will take their share, 50% share. That is 2.5 crore is their EMI. They will take that, and the remaining 2.5 crore, they will split it to these people in their ratio. So I am only in talks with SBI here, because that is a lead bank. Just understand that. You have to understand that concept, else it is literally going to be tough. 1 second, guys. Charge is not there. Yeah. So consortium advances means advancing loans to a borrower by 2 or more banks. Simple. So here a bank with a higher share is called as will lead the consortium. That is lead bank. Where remittances, one more thing. This sentence is very important. This they can ask literally very tough questions from this. That is why I'm explaining like this. So imagine my monthly EMI is say 5 crore, and in this 5 crore basically 2.5 crore, the 50% is in the ratio is applicable to SBI. And imagine, hypothetically I'm saying something, I don't know the calculations they are not put. Imagine 1 crore and another 1.5 crore is given to HDFC, and another crore is applicable to Bank of Baroda. So this 5 crore total I will give it to SBI, and SBI will take their share and split it to these people. I told you. So there is a very big problem in this. Sometimes SBI will not, sometimes SBI will not give this 1 crore to this HDFC or Bank of Baroda. It is SBI's duty to do that, but SBI sometimes will not do that. So, but SBI's book, I have paid the proper money, my asset classification will, everything will be proper. But these people have not received money. From my money, they have not received. In that case, in these people's books, my account will be turned as NPA. If 90 days later they have not received any credit. It is not my problem. I have paid the money to SBI, but if they have not received, these people have not received the money, still they will classify my asset as NPA in their books. Understand this? It is basically not a good thing, but still they are doing it. Because it is this bank's responsibility is there to get the money from SBI. They need to form an agreement like that, and the SBI also has a responsibility to pay this bank. Okay, so keep that in mind. That is where it is written. Where remittances from the borrower under consortium are pooled with one bank, that we are giving every remittance to SBI, and where the bank receiving the remittances, SBI, is not giving their share to other member banks. They are not giving the share. The account should be treated as not serviced in the books of other member banks, and therefore it will be treated as NPA. Other banks. Okay, understood? This understanding is important. Like I told you, we are learning it like DT. Detail we are understanding. In this case, this tax will come, why this is coming, learning like that is what you need to learn. Don't memorize anything, it is very tough. Just understand like this, and you can write in your own language also with the red highlighted keywords. Then yeah, agreement, everything I told you. Then drawing of calculation and all these things, the everything, the responsibility of drawing power, the power, all these things relies with the lead bank. Lead bank will talk with other banks, and then they calculate. Lead bank may give a lower share of the drawing power. It's all these things simple. You will read and understand. Then accounts where there is an erosion in the value of security or fraud committed by the borrower. Very, very important. Understand. It simply means I needed a 70 lakh loan. I have a 50 lakh property. I gave it to the bank. So bank gave me 70 lakh loan. Okay, happy. But after this was a 10-year loan. But after 2 years, sudden earthquake or some flood happened in my area. And my area is now, it's like Chennai, some areas are there where flood happens. So when flood happens, that area's value will go down. Nobody is going to buy real estate in that area. So my property, which was worth 70 lakh, and I take a loan from bank for 50 lakh, but now that my property's value has gone down to 25 lakhs because of the flood affected area. So now that is what we call erosion in value of security. My property was bank security, and that's the property's value has been eroded. That has gone down from 70 lakh to 25 lakh. So the loan I took was, say, 50 lakh was the loan I took, and now I have repaid. Last 3 years were done, I have repaid almost 10 lakh. So outstanding balance loan amount still itself is like 40 lakh is still pending as balance. But my security, which was worth 70 lakh, went down to 25 lakh. So now bank is at risk. If I don't pay the money, what will bank do? Bank can recover from my security. They will only get 25 lakhs, but the loan outstanding is 40 lakhs. That is what we call erosion in value of security. First case. Second case, frauds committed by the borrower. Frauds committed by the borrower means my property is actually worth only 35 lakhs. But I hired some registered valuer and I did some fake valuation and all these things, and I gave a fake valuation report, like 35 lakh or property, I valued it as 75 lakhs, and I submitted it to the bank, and bank's valuer also came. I also gave him some bribe and asked him to increase the value. So my property, which is only worth 35 lakh, I did fraud with the bank and showed them it is worth 70 lakhs, and I took a loan of 50 lakhs. So basically a fraud happened. The actual value of security is not that much. That is called the fraud committed by the borrowers. So in this case, what should an auditor do? Erosion means gradual destruction or diminution of value of something. It should be straight away classified as doubtful asset or loss asset as appropriate as follows. If there is an erosion value of security, that loan account should be classified as doubtful asset or loss asset based on this requirement. Or fraud, you have to do this. Then erosion value of security can be shown as significant when realizable value of security is less than 50% of the value assessed by the bank. That is, at the first time, when bank gave me loan, they took my property, they valued my property at 75 lakh and they gave me 50 lakh loan. So now, because of the flood, my value of the property became 25 lakhs. So initial value assessed was 70 lakhs. So now the value is only 25 lakhs. So it is more than 50%. More than 50% the value has come down. The 50% of 70 lakh is 35 lakh. My value is only 25 lakh now. 25 lakh. So more than 50% if the value has been gone. That is erosion value of security. If it is more than 50% of the value assessed by the bank, then it is called as a significant erosion. More than 50% if it comes down, it is called significant erosion. Such a thing should be, such NPAs may be straight away classified under doubtful category and provisioning should be made. That is, if I am not repaying the money, my securities value has already come down and I am not repaying the money for 90 days also. So my account becomes NPA. So if it is such a kind of account where the value of the security has come down and I am not paying the money also, that such NPAs should be no substandard category. Straight away from standard category, you need to classify it as doubtful category and provision need to be made. Doubtful 1, doubtful 2, doubtful 3. So understand, my value of the security come down and I am not paying to the bank also for last 90 days I have not paid the EMI. So the two condition it becomes an NPA. When it became an NPA, suddenly don't classify it as substandard, directly classify it as standard. So the moment it becomes NPA, normally it goes to substandard category for 12 months. No, directly go to doubtful because there is an erosion value of security or fraud committed by borrower. Then if realizable value of the security is less than 10%, imagine here 70 lakh was a property and because of an earthquake happened in my area, my building completely destroyed. And that area land very less value, sir. So now the value is only like say 5 lakh is the value of this property. Bank initially assessed 7 lakh, but then now the value is only 5 lakh. That is less than 10% itself is 7 lakh. But even though even lesser than 7 lakh it went. So in that case, that is, if the realizable value of the security is less than 10% of the outstanding in the borrower accounts, or the existence of security should be ignored and asset should be straight away classified as loss asset. So one thing, guys, you have to keep in mind, one mistake I did. That is, once more I'll say, wait. That one point, it's very important. The calculation questions may come. That is why I'm saying. So the value of the property was 70 lakh and bank gave me 50 lakh loan. 2 years are over. I have paid almost 5 lakh repayment. I have paid almost 5 lakh repayment I have paid. So outstanding balance with interest, imagine, etc. is a 45 lakh is outstanding balance. And 70 lakh was my property's value. And now because of the earthquake, my property's value went down to say 3 lakhs. So if in the first case, you are comparing this 50% thing, 50% reduction in the value, you are comparing it with the 70 lakh. 70 lakh or 50%, is it less than 50% of this 70 lakh you are taking? But in second case, you are considering whether it is less than 10% of this 45 lakh outstanding balance. First case, 50% of the initial value assessed by the bank. The second case, 10% of the outstanding balance. Okay, so don't consider 10% of this. Okay, that is what is a difference. It is very, very crucial. Practical question may come in MCQ. You may commit a miss. 10% of the outstanding in the borrower accounts, 50% of the value assessed by the bank. So write this calculation in a sticky note on the side and keep it, because if they are making a tough question paper, this things can come in descriptive or MCQ as practicals. Practicals means a case based, they will include this. You have to write what classification it is. Then all these things are basically easy. Asset, NSC, KVFC, not be treated as NPA because adequate margin is there. Agriculture advances, like bank has given some agriculture loan to someone and a natural calamity happened, flood, something happened, agriculture is completely destroyed. In that case, NPA classification, everything, bank may decide their own relief measures. Bank can decide what to do there. Should they classify as NPA? What should they do? All these things. Bank has the power to decide. No fixed rule is there. Bank has RBI has given the power to bank. Then advances to the staff. All the loan that is given to staff. This is very easy. You just read, you will understand. Then agricultural advances. Agricultural advances for long-term, long-duration crops and short-duration crops. Imagine mango. So only one season is there. In 1 year, only one season comes. That is called a long duration crops. I am a bank. I have given a loan to a farmer who is doing mango business. Mango cultivation is doing the mango, and for producing mango, we have given him a loan. Mango is a long duration crop. Okay. So for those things, if he has not paid the money, loan granted for a long duration crops will be treated as NPA if installment of principal or interest remains overdue for one crop season. One crop season, that is 1 year if it is overdue, one crop season if it is overdue, then only we will classify it as NPA. For long duration crops. Okay. For short duration crops like banana, if it is overdue for 2 crop seasons in a year, like 2 crop seasons, like one season is imagine 3 months, 6 months if it is overdue, then we will classify it as NPA. For long duration crops, only one season is there. So one season extra if it is overdue, we will classify it as NPA. Short duration crops, if it is overdue for more than 2 crop seasons, you will classify as NPA. So keep this in mind. Okay, keep the example in mind. Then computation of drawing power, literally very, very easy. So just understand simple thing, guys. Drawing power means stock given, because drawing power calculation is for this one. Cash credit and overdraft facility. Basically for cash credit, you keep in mind. Cash credit, you wanted a working capital money for cash credit. You approach the bank. And bank gave you working capital this loan, and bank told we will give you this working capital loan provided you should give us every 2 months. You need to submit your stock statement, whatever is your stock, like 2 months in, what is your current stock in hand, other statements you have to submit to the bank every month. We have to do that stock statement plus debtor statement also we have to give. Okay, so drawing power, how the bank calculates the drawing power, it is based on the stock statement we given. Stock statement plus the debtors order statement whatever we give minus creditors, that is creditors in the stock. Imagine you purchased a 10 lakh worth of stock. In that 7 lakh you purchased with cash and 3 lakh is credit. So that credit portion we will exclude from the stock. That portion, only 7 lakh will come. Okay. Stock minus debtors plus creditors is minus margin. Bank will keep a margin. That is, imagine they need a margin, right? Like for their safety. So that margin amount. When we do a practical, you will get understand. Drawing power is important in the calculation of cash credit facility. Drawing power is a limit up to which a firm or a company can withdraw from the working capital limit sanctioned. Okay. That is sanctioned limit. Imagine the sanctioned limit is at 10 lakh. The drawing power they will calculate every 3 months or 6 months. They will calculate the drawing power, and that may based on the stock statement. What is the stock statement given by the company or the borrower given stock statement? Based on that, bank will do the calculation like this, and we'll get the drawing power. So now we are going to learn the calculation. Before calculation, just we'll do the calculation and see. Just this one question. Compute the drawing power for the cash credit account of Kripa Limited for the month of 20. I'll quickly go. You can take a screenshot of this also. Stock is 60,000. Debtors 55,000 is the total debtors. The one debtors that are old is there, or debtors older than 3 months are ineligible for calculation of drawing power. They have given it. So this 15,000 we will exclude. This fully we will take. Debtors 40,000 only we will take. Sundry creditors 10,000. So 10,000. This 60,000 we have bought almost 10,000 rupees worth of credit. So this we will reduce. Sanctioned limit is a 48,000. Wait. Margin on stock is a 30% and on the debtors they are keeping a margin of 40%. Okay. So first we will take the stocks. Stocks are 60,000 we took. Less sundry creditors. I told you stock you reduce sundry creditors, you will get the paid stock. Stocks for which you have actually paid cash is 50,000. Okay. From that, you will reduce the margin on stock is 30%. Into 30% is 15,000. You will reduce that and you will get 35,000 as stock item plus stock minus creditors plus debtors you have to include plus debtors is 55,000. Then ineligible is there 15,000 that you will reduce 40,000 you got and margin on debtors is 40,000. So when you multiply by 40,000 you will get 24,000 as remaining. So this is stock minus creditors is there plus the debtors you add minus the margin also you have minus, you will get this figure. So stock we added minus stock minus creditors we added minus the margin we did, debtors also minus margin we did, this thing we will get this 59,000 as the figure. So 59,000 is a drawing power, but there is a problem. Drawing power will never be more than sanctioned limit. If the sanctioned limit is set 10 lakh and drawing power is say 8 lakh, the customer can withdraw only this much. This is the maximum. That is whichever is lower, that is the maximum amount a customer can withdraw. If sanctioned limit is 10 lakh and the drawing power is, say, imagine because of the stock statement, based on the stock statement, when we calculate the drawing power came to 11 lakh, here also, even though the drawing power is 11 lakh, you can withdraw only whichever is lower. So up to 10 lakh only you can withdraw as money. That is, a customer can, borrower can withdraw as money from the bank. So the sanctioned limit given in the question is say 48,000 and drawing power is more here. In that case, the customer can only withdraw up to 48,000. Okay, sanctioned limit given in the question 48, whereas drawing power is 59. So drawing power would be restricted to the sanctioned limit rate, that is 48,000. So if it is more than sanctioned limit, then you will automatically cut down the drawing power to the sanctioned limit. That is, whichever is lower, that is the maximum amount will be the drawing power. Above that, you cannot draw. Hope you got a clarity. Then auditor's concern. Stock statements, quarterly returns and other statements submitted by the borrower to the bank should be checked by the auditor. For all the cash credit facilities, you take some cash credit facilities on, like cash credit accounts of the customers on sample. All the stock statements, debtor statements, everything given by the customer, check that in a detail, some on sampling basis. Audited annual report submitted by the borrower should be scrutinized properly. All these things. Then computational drawing power we learned right now. It is basically the guidelines are formulated by the board of directors of the bank. For drawing power calculation, what are the things to be included, excluded, all these things, guidelines are placed by the board of directors and also agreed by the statutory auditors. So the board of directors of the bank plus the statutory auditors of the bank, both will sit and decide how to calculate the drawing power for the bank, the guidelines. Special consideration should be given to proper reporting of creditors for the purpose of calculating drawing power. I showed you, list. Then stock audit should be done. Stock audit, imagine I am a bank and I have given a loan to a lot of people. Cash credit loan for working capital. So then they are giving me stock statements, all these things. How can I trust them? So I should do a periodical stock audit of them. They are giving me, they are saying that we have 10 lakh units worth of stock and they are giving a statement. We should go and check there with our eyes, right? Whether the 10 lakh units is there. So it is bank's responsibility that if bank is giving a loan to someone for a cash credit loan, bank has to do a stock audit of that customer. And so bank will appoint an auditor. That auditor will go and check the stocks of that borrower and will report it to the bank. So, and this auditor's fees, everything is paid by that company itself, not by the bank, the borrower itself. Okay. That is what we call stock audit. Understand? Then now comes audit of advances, another crucial area of this chapter. That is very easy. All these things are very easy in carrying out the how to do the auditing of loan given by a bank, how to do the auditing. In carrying out the audit of advances, auditor is concerned with obtaining evidence about the following. That is, auditor has to obtain evidence about basis of valuation, what are the unrecorded, no unrecorded advances are there. Then what are the amount, advances only means amounts due to the bank only, not any other amounts are included in advances. Then amount included in the balance sheet in respect of advances are actually outstanding. Only outstanding balance is included in advances. Something that is not outstanding, chumma, that is not included in advances. Auditor has to check that. Then all the advances means the amount due to the bank and it is supported by loan documents. All the advances given by the bank, proper loan documents are there, auditor has to check. Then accounting policies and all these things, proper provision has also been put. So this is Ban Dosha provisions. Ban is there, Dosha is there, provision is there. Ban means B. B means basis of valuation, you have to check. Then UN means unrecorded, no unrecorded advances are there. Memory technique. Dosha, D, the amount due to the bank, outstanding, supported by loan documents, accounting policies. Then one, those are provisions, simple. Then idellam a very easy point. Then also all those are easy. Then in evaluation of internal control over advances should include all these things. This is very easy. You'll read and you will understand. So next is, guys, income of the bank, auditing the income of the bank. So income of the bank is divided into two things. Basically, the most important income, that is the income from interest, which we learned how to recognize the income, all these things, like based on NPA. Like if it is an NPA, then recognize it on receipt basis only. Only when you receive, you can recognize. If it is not an NPA, then accrual basis. This is regarding interest. Then other incomes are there for the bank. Commissions they receive, brokerage they receive, all the charges they take. All these things are other income for the bank. Just read it once. You don't have to memorize anything. Profit on sale of investment, profit and loss or revaluation of assets, all these different commissions, brokerage, everything. Then how to audit the income? We'll focus on the important areas. RBI's direction. That is, if any income other than interest obviously we learn how to recognize. Other incomes, basically commissions, brokerage, all these incomes, if it exceed 1% of the total income of the bank, total income, total revenue is 1%, that is gross basis revenue, or 1% of the net profit before tax, if they are considering income was net of cost, that is profit basis, those income should be recorded on accrual basis. If there is any commission or other incomes like that, you can recognize it on accrual basis. Any income which exceeds 1% of total revenue or net profit, you can recognize it on accrual basis. If bank is considering total revenue as their income, then 1% of total revenue you have to check. If bank is considering net profit before tax as their income, then you have to consider net profit. Okay, 1% of net profit. When a credit facility is classified as non-performing for the first time when it becomes NPA. Imagine I took loan from the bank and I have not repaid. For the first time I'm doing this, 90 days I have not repaid, it become NPA. For the first time when it becomes NPA, interest accrued and credited to the previous year, which has credited to the income account in the corresponding year, which has not been realized, should be reversed. That means, I'll say, imagine let's take 3 months. Let's take 3 months. This is December, this is January, this is February, this is March. This is March 31st 3. Okay. Till here, till November I have paid the money. Till November I have paid the money. December I have not paid. 1 month, 2 months, 3 months. 90 days are over here. Here 90 days are over. So my account should become an NPA here. So, but these 3 months it was not NPA. So these 3 months it was not NPA. So these three, imagine the EMI, the interest component is 10,000, 10,000, 10,000, 10,000. Here also interest component is 10,000 every month. So here we have, since it was not an NPA, NPA became only from here onwards. So, but these three incomes also we have not received. Since it was not an NPA, we would have already recognized it on accrual basis. Like December it was not an NPA. Since November, till November I was paying everything properly. So this income would have been recognized already on accrual basis. This was already recognized on accrual basis. This was also already recognized on accrual basis. But from here onwards, it will not be recognized because it became NPA. So from here onwards, the receipt basis only you will record the income in the bank books. But so when it becomes NPA, any income which has been previously credited, that is these three incomes has been recorded as income, but that has not actually been received, which has been previously credited but has not actually received, you need to reverse these three because these three has not been received and account becomes NPA. From here onwards, all the things you will record on receipt basis only, but these three things you have to reverse. It was shown as income, reverse it now. That is what they are saying. This will apply to government guaranteed advances also. We learned what is the provision, central government and state government guaranteed advances, same thing. Then advances against securities. That is bank, someone has given us this security, that is Indira Vikas Patra, a national savings certificate, all this. I have a national savings certificate. I gave, imagine it is worth something. I gave it to the bank and against which I take a loan. So in those cases, if I'm not repaying it to them, don't classify it as NPA because these things are immediately realizable. Bank can immediately fetch money by selling this. So for those things, you don't need to recognize as NPA, provided as adequate margin is available in the account. That is the value of the NSC that I gave, imagine is at 10 lakhs. And I took a loan from the bank for that of say 6 lakhs. So 4 lakh margin is there. The adequate margin depends upon bank's judgment. Right? It can be 1 lakh, 2 lakh, 3 lakh, 50,000, whatever. So now here is a good margin is there. My amount is only 6 lakh and together with interest, I have not paid it. Total accumulated to is like 6.5 lakh. So still adequate margin of margin is there. 3.5 lakh margin is there. So in this case, you don't need to recognize it as NPA. You can normally show it as normal thing itself, not NPA. Provided an adequate margin is there. This is only applicable for advanced against these securities. National Savings Certificate, Interest Vikas Patra, Kisan Vikas Patra, and all these things. Then bills purchased, bills for collection. Very, very important. Bills purchased. What is actually bills purchased? Imagine I have a bills. Imagine I have bills worth 50 lakh, and this is imagine on what date you can say for better calculation. Imagine it is on March 1st. I have a bills worth 50 lakh, and it is to be collectible on. It is to be collectible. I am going to receive it's a bills worth 50 lakh, 4 months credit period, credit la. So I am getting this on say June 1st. I will get this money. This is the bills I have with me. Imagine the value of it is 50 lakh. Now, but I need this money immediately. March 1st itself, I need this money. So what I will do, I will go to the bank, sell this bill to the bank, and I'll get, bank may pay me 48 lakhs rupees or something. So 2 lakh rupees is bank's income. And what bank will do? Bank at the June month, bank will directly collect money from that borrower, that person, my debtor, he will directly collect money from like 50 lakhs bank will collect. So bank will get extra 2 lakhs. So bank is actually purchasing the bill. We have to think from bank's perspective. Bank is purchasing the bill here. Okay. So in that case, what should we do? So this 2 lakh is bank's income. Bank gave us only 48 lakh for the bills and bank is getting 50 lakh on June. Okay. So in case of bills purchased outstanding at the close of the year, the discount received thereon to the bank should be properly apportioned between the years. It simply means that March 1st, bank bought bill from me. So imagine, So 2 lakh is the income for the bank from bills. 2 lakh income bank will get extra. So 2 lakh income. So what is the duration? 4 months is there. So as on 31st March, when bank is preparing the accounts, only 1 month is over. So 1 month's income should only come in this year. Imagine the previous year is a 22-23 is the current year, financial year. So when you're preparing books of accounts for financial statements for 22-23, only for 2 lakh is the total income for the bank. But in this, only 50,000 is the income which bank has earned till now. March only income. March 1 to March 31st income is 50,000. Like 4 months are there. 2 lakh divided by 4, 50,000 each month. So 50,000 income bank has actually earned. You will be receiving it only on June, but still it has earned. Then rest 3 months, April, May, June, April, May, June, he will receive the things, right? That 1.5 lakh, he will, one calculation mistake. March, April, May, June 1st, here he will be receiving it on July 1st, upper than 4 months. Okay. So those 4 months income, 3 months thing, 1.5 lakh rupees. This 1.5 lakh rupees should be recorded as income in 23-24's financial year only. Because this is the only income bank earned current year. That is what they are saying here. The unexpired discount, that is the unearned discount of 1.5 lakh or the rebate on bills discount, both the things are same. Where part of the receipt comprising discounts, it should be shown as other liability. That is 1.5 lakh, other liability, so you can show it. But is interest not earned till now. Income not earned till now. 1.5 lakh is not earned till now. Then the interest come. This is another thing. This is rediscounting of bills from the bank. That is, imagine I am a bank, not customer, bank. I have total bills worth of say 10 crore bills worth. Different customers, I have total bills worth of 10 crore. And now I think that I bank wanted immediately money. So bank, this is a total bill that bank has already have in their hand. So bank, what will they do? Bank, if they need some money urgently or something, bank will sell these bills to another bank. SBI will sell it to ICICI. And ICICI will pay this bank, SBI, 9.5 crore. So 50 lakh is ICICI's income, like this bank's income. So this is rediscounting of bills. Bank already purchased those bills for discounting. And now bank needed urgent money. Bills will be received, money will be received on next 2-3 months after. So bank will sell all the bills to another bank, rediscounting. So here 10 crore worth of bills was there. It was given to another bank, and this bank received 9.5 crore. The number bank received 9.5 crore. So this 9.5 crore, now our bank, imagine our bank was SBI and this is ICICI. Now SBI lost almost 50 lakh rupees. This is basically a loss on rediscounting of bill. They lost this much, right? So this is a loss, and bank would have earned so much money through bill discounting. This is some bill Imagine banks are total bills with them with their hand is say 50 crore. In that 10 crore they are rediscounting. Another 40 crore bills are there with the SBI. This 40 crore bills, they would have earned so much income. That income is there and this loss is also there. Don't net this income and this loss. So here 2 lakh income, 50,000 is current year reckoning. That is income of the bank. Don't net off this loss with that income. Show this as separate. Loss separately you have to show, income separately you have to show. That is what they're written here. Interest component paid by the bank or branch on rediscounting of bills from another financial is not netted off from the discount earned on bills discounted. Simple. So the next is bills for collection. So here bank is not purchasing any bills. Here bank is just an agent. That is, bank will, imagine I have a bills worth of 10 lakh bills. I'm a customer. I will give my bills to the bank and I'll tell my bank, please collect it on my behalf. So here bank is not purchasing any bill from you. Here bank is just an agent. So bank is not getting any discounting income. That discount they are not getting. Here their income is, I have a bill, I have a debtor, I have a bill, I gave the bill to the bank and bank will collect money for me from that debtor. The debtor will pay money directly to the bank. Imagine debtor pays 10 lakh. Now bank will charge a small commission or fees from me. That is only bank's income here. Here no discounting income is there. So guys, understand, when I give my bill to the bank, in the bank's book, no journal entry is made. Bank will not make any journal entry at that point of time. They will make the journal entry only when that debtor pays money to the bank. That time, when debtor pays money to the bank, in the bank's book, bank has earned that fees. Imagine 2,000 rupees is the fees. So when debtor pays 10 lakh to the bank, it's like bank earned 2,000. So at that time, on accrual basis, they will put that journal entry, 2,000 rupees receivable. That like they will put the journal entry, and then after 1 week or 1 month, sometimes I'll pay that. Not sometimes I'll pay that 2,000 rupees. Or bank may take 2,000 rupees and give me that 9,98,000 rupees back. So that is the process of bills for collection. So here, see, the auditor should examine the procedure for crediting the party on whose behalf the bill has been collected. Like crediting me. First time when I give the bank the bills, no entry is coming. Only when the bank receives the money and gives it to me, that time will only journal entry, this crediting things will come. So auditor has to check whether that journal entries are correct. Then the procedure is usually such that the customer's account, my account in the bank, is credited only after the bill has actually been collected from the drawee. That time only they will credit my account, and their income, that is their commission, will be only become receivable, becomes accrued only when they receive the money. That is, the commission of the branch becomes due only when the bill has actually been collected. Okay. Hope you understood these two complicated cases. Okay, understanding is needed, not memorizing. Then renegotiations. Renegotiations is very easy. That is just renegotiating the terms. The fees and commissions. Imagine I have a loan worth 10 lakh. I take a loan of 10 lakh from the bank and the period is say 5 years. 5 years. Imagine the loan taken. I'm giving everything practical because this chapter is a practical kind of case they are asking for question. They can come. Let's learn everything like that. Theoretically also we'll learn, but once you understand it practically only, you will be able to memorize theoretically. That is a problem with here. So imagine I took a loan of 10 lakh and it is at the interest rate of say 10% and the term is for 5 years. So imagine, hypothetical example, I'm not calculating anything. Imagine the EMI per month is say 50,000. Just hypothetically imagine. So this is my loan. So first 2 years I paid money properly. But then after 2 years, I don't have the cash flow. My job got, I resigned from my job. I don't have money. So I'll go to the bank and tell bank, I cannot repay 50,000 EMI every month. Can you do some recalculation and make the EMI less than 25,000? I can pay 25,000 a month because I now don't have a job. So what bank will do? Bank will agree. Bank will give, so remaining, imagine 2 years I paid. So the remaining outstanding balance is 7 lakh. 7 lakh. Bank will increase the interest rate there because bank is doing us a favor. Bank needs to get some extra money, right? Bank will increase interest rates to 12%, but remaining 3 years are there. So bank will increase the term. Term also they will increase to say 12 years they will increase the term, or 10 years they will give us the term. So EMI will come down. EMI will come down to 25,000. So here renegotiation happened in the terms. This was the first term. But since the customer was unable to pay, borrower was unable to pay, bank renegotiated the term. So for giving this renegotiation, bank will charge some fees or commissions. So that is what is mentioned here. Fees and commissions earned by the bank as a result of renegotiations or rescheduling of outstanding debt, it can be recognized on accrual basis over the period of time covered by the renegotiated or rescheduled extension. That is here 2 years was already over. So another extra 10 years was given. So 12 years is the term. So how much term is left? 10 years left. So Imagine we paid a bank 50,000 as renegotiation fees. This 50,000, the bank cannot immediately recognize it. Bank can recognize it on accrual basis, but over the entire period, over the 10 years, they can recognize this 50. Divided by every month, the 10 years, they can recognize it. Just understand, no, nothing, don't even think too much practical. Just understand this thing, just basic practically for learning the theory. For learning the theory, you need to understand this basic practical. That's enough. You don't have to, they'll not give you any practical question to solve this. No. Just for understanding, learn the practical side. Then test check the interest earned by the bank for the sample selected. Then test check the fees and commission. Simple. Then reversal of income, another important area. If any income including the bills purchased and discounted becomes NP, I told you we need to reverse 3 months. Where was it? Where was it? See, not this one. Like this example I showed you. Like account becomes NPA on this date, so these 3 months income was already credited. We need to reverse it when it becomes NPA. Same thing they are saying here. If any advance, including bills purchased or discounted, any advance, any loan, not a normal loan, bills purchased, discount, anything becomes an NPA, the entire interest accrued and credited to the income account in the past period, which should be reversed, which has not been received, you have to reverse it. If the same is not realized, same is not received. This will apply to government guaranteed advance also. Same point we learned above. In respect of NPA's fees, commissions, I'm going in a bit quick, so you can pause it, process it, then resume it. Okay. In respect of NPA's fees, commission, all these kinds of income, similar income that have been accrued should cease to accrue if the current period and should reverse or provided for respect to the past periods if uncollected. Same point like here. So when it becomes an NPA here, from here onwards, you should not recognize it on accrual basis, only on receipt basis. That is what they're saying. Guys, then this point, that is current year. Imagine the current year is say financial year 22-23 and the next year is say financial year 23-24. So there was one income of April. It was an actually interest income of April 2023's income of imagine 10,000. It unknowingly got included in 22-23's financial year. That is, it unknowingly got recorded in March 2023. So actually it should be coming in this year, but it unknowingly got in this year. In that case, what should you do? Anyways, 22-23 is over. We cannot do anything on that. So now two options are there. Either if this included 10,000 income is included in 23-24, the 10,000 income comes in 23-24 also. So it's like double recording. In that case, you have to reverse this 10,000. That is, you have to eliminate this 10,000 from 23-24's books of accounts because it is actually already recorded in the year once. That is the first option. Second option is that for better presentation purposes, because this is 23-24's income, right? So this you can include in 23-24, no problem. But at the same time, against this, an opposite provision you need to give, an expense kind of a provision you need to give for 10,000. So the net effect will become zero. Income is only recorded once. That are these two things you can do. So number one, that income got recorded in this year. So same amount if it is coming in this year, you can reverse that. That is, you can eliminate that, delete that. That is one option. Second option, if for better presentation you want that income to be shown in the income side in 23-24, you can do it. But at the same time, give an opposite provision to that in 23-24 itself, 10,000 rupees provision. So net effect will be zero. So this is what they have said here. In case which a bank has wrongly recognized income in the past, they should reverse the interest if it was recognized as income during the current year. If it is already recognized in current year, reverse it, or you can make a provision for an equivalent amount. If you want to show it in current year, okay, you show it, and oppositely you put a provision. Then on leased asset, the component of finance income on the leased asset which was accrued and credited to the income account before the asset became NPA and remaining unrealized should be reversed. Same like that. If any leased asset anything becomes NPA, all the income that is already received but already recorded but not received yet, accrual basis you recorded but account becomes an NPA here, all those things you need to reverse it. Same thing should be reversed or provided for in the current accounting period. Then takeout finance. What do you mean by takeout finance? It is literally very important. Just understand. Takeout finance means, imagine I wanted to construct a shopping mall. I'm a businessman. I wanted to construct a shopping mall. The money I need is say 1,000 crores. So 1,000 crores I went to SBI. Just like earlier we learned the same example. Similarly, I wanted 1,000 crores. I went to SBI. Now SBI is saying, bro, now you only have a land and the land order value is say just 200 crore. So for that land, how can I give you 1,000 crores? Now you don't have the credibility. You don't have the security also. Now I cannot give you 1,000 crores now. you can do one thing. You can go to some other bank, other IDBI, all these banks will give these kinds of loans. You can go to some other bank and you can take this 1,000 crores from them. They may charge you higher interest. Imagine SBI interest is very low, because I need a tenure of say 50 years or 20 years or tenure I needed. No bank will give that, only SBI will give that. Understand? Hypothetically, I'm saying. So I went to SBI, asked 1,000 crores. They are saying, now since you don't have bigger security, I cannot give you 1,000 crores. You can do one thing. You can go to IDBI bank and take this loan. IDBI will give you this 1,000 crore. But IDBI's interest rate is very high. IDBI will only give you 10-year tenure maximum or 5-year tenure. But you go and take the 1,000 crore from IDBI, take it for higher interest. Then what I will do, SBI is speaking, SBI will say, what I will do, with that 1,000 crore money that IDBI gave you, you construct the mall. So in 6 months, you can finish construction of a mall, or 1 year you can finish construction of a mall. So 1 year you pay interest, everything to IDBI. Once your mall has been constructed, it is finished, now you have a land and you have a very big building also. Now you can come to me and now I will take over the loan. That is, SBI will say, once the building is constructed, SBI will take over this loan from IDBI bank. So then SBI will give this borrower for me, like SBI will give a very long duration and very low interest rate. SBI will take it over. So till then we cannot give you that money. Then you can take it from IDBI. So basically, I am a borrower. I need a loan from SBI because I'll get low interest rate and long tenure. But now, for the time's sake, I'm taking it from IDBI bank, and SBI, I have an agreement that SBI will take over this loan after 1 year, once the construction is finished, once certain conditions are fulfilled. They have an agreement with me and IDBI. That is called a takeover finance. SBI is taking over my loan from IDBI. So there are those high interest and less tenure. SBI is taking over because they'll give it to me for lower interest and longer tenure. Okay. So takeout finance, takeover, that is takeout. Takeout loan is a method of financing where a loan that is procured later I am taking the loan from SBI, is used to replace the initial loan. Initially, I am taking the loan from IDBI, and then futurely, I will get the money from SBI. That is basically SBI will take over this loan, takeout. More specifically, a takeout loan or takeout financing is a long-term financing that the lender promises to provide at a particular date. Lender, SBI will promise. SBI will say, after 1 year, I will take out the loan, or when a particular criteria is fulfilled. Either they will say, after 1 year, I will take out the loan, or SBI will say, after you finish completion, that is one condition they will put, then I will take over the loan for the completion of a project are met. Okay, takeout loans are commonly used in property developments, buildings. Then in case of takeout finance, if based on the record of recovery, account is classified as NPA. Record of recovery means money has not been paid for 90 days. That is, recovery is not there. If it becomes NPA, it should recognize income unless realized from the borrower. Same thing. It should not recognize income unless realized from the borrower. Same thing what we learned above. What is the objective? Very easy, just learn it. So the next one is on partial recoveries of NPA. That is the partial recovery. It simply means that, let's look at this example. Total I have taken 6.5 lakh from the bank loan and I have not paid anything. So account becomes NPA and the total accumulated interest is 1.5 lakh. So total outstanding balance is 8 lakh. So I have to pay this much balance is pending. But I have paid only 1.8 lakh to the bank. That is partially some money I have paid it to the bank. So how to adjust this money? Should they adjust it to the principal? So normally with this 1.8 lakh, should they adjust it with this 1.35 lakh interest, or should they reduce this 1.8 lakh to the principal amount? So there should be a decision on this. So two things are there. If there is a clear agreement between me and the bank, that is, while taking the loan, there was an agreement. If I became NPA and if I then later, if I pay the money, that is partial money, if I pay, directly adjust it to the principal. If such kind of an agreement is there, then bank will follow that agreement and adjust the money accordingly. If there is no agreement between the borrower and the bank, then bank can frame a policy and bank can decide where to adjust it. So bank may have an internal policy. Bank directors, all these people will sit on partial recovery of NPA. We will only adjust this amount to the interest first, then remaining, if anything, only we will adjust to principal. Thereby, bank may have these kinds of accounting policies. So first option, if there is a clear agreement between borrower and the bank, then the bank will follow that and adjust money accordingly. If there is no clear agreement, then bank will follow their own accounting policy, whatever the decision they have taken. That is on partial recovery of NPA. Same thing they have written it here. So normally, in the absence of a clear agreement between bank and borrower for the purpose of appropriation of NPA, banks are required to adopt their accounting policy and follow like that. Appropriate policies recognize income as per AS9 when certainty attaches to realization and according amount reversed, recognized or recognized in the past should be accounted. It's simple. Then this interest partially or fully realized in the NPA can be taken to income. that is whatever money I paid, this bank can consider that as income because actually it has been paid, not accrued, it has actually been realized. So those, even though account is NPA, they can still take that. Then however, it should be ensured that the credit towards this interest, whatever money I am paying, this 1.8 lakh should not be from any extra loan that bank has given to me, because already my one loan is NPA and still bank gave me another loan, and with that loan I am repaying this. That should not be there. That auditor should check. That is, it should not be out of any fresh or additional credit facility sanctioned to the borrower concerned. It's very simple. Then there is a memorandum account. Memorandum account means if I'm the bank, one borrower is there, he became an NPA last 6 months back. So last 6 months income I'm not recording anything because I have not received any money. But that 6 months interest, I should record it in a separate account. I should, like books of accounts normally it should not come. But separate account we will create for just calculation purpose. Because separate account, separate book we will record that 6 months whatever interest is accrued but not received. Those interest we will record it there. Those 3 months interest we reversed. All those things we will record just for safety. It will record and keep it there. But normal books it will not come. Normal books will recognize it only when it is received. That separate book is called a memorandum account. Then next is income from investments. It is literally very easy. Interest income on investment. This include all the income derived from the government securities, bonds, debentures of corporates, all the things by way of interest and dividend, everything. That is interest income for the bank. Bank will have extra money and bank may invest it somewhere else. So whatever money, interest or dividend the bank is receiving, how should treat that? They can recognize that as income, except income earned by of dividends, etc. from subsidiaries and joint ventures. If bank has a subsidiary joint venture, money received from them, they should not recognize as income. Other things they can recognize as income. Then broken period interest paid on securities purchased and amortization of premium on SLR investments is net off from the interest income on the, if there was any broken period interest or there is any amortization of premium on SLR investment, it should be netted off from the interest income on investments. It should be netted off. So the next is auditing of expenses of a bank. So bank has basically 3 types of expenses: interest expense, operating expense, and provision and contingency. It is very easy. You can easily understand by reading, but still some complicated areas are there which I will explain. That is how to audit the interest expense of a bank. So interest expense means bank may accept FDs and other deposits from customers and bank will pay them the interest. That is what we call interest expense. So first thing auditor has to check is, auditor is primarily concerned with assessing the overall reasonableness of the amount of interest expense. He has to check the overall reasonableness of interest expense. It simply means, imagine the bank's policy is their average interest rate is say 7%. 7% is the interest that they give on FD, and for senior citizens, imagine it is 8%. This is just hypothetical. Hypothetically, we will take it as 7%. So this is bank's policy that we will only give 7% interest. So what we need to do, we need to assess the reasonableness of all the interest paid by the bank. Sometimes imagine for some customers, bank has paid some extra interest. We don't know something. We need to check, right? So for that, we'll take the ratio of all the interest paid. Total amount of interest paid is say 10 crore. So 10 crore is to what is the total amount of deposits, total amount of FDs accepted by the bank? It is say 70 crore. So not say 70 crore, 10 crore is to, we can take it as 10 crore is to 100 crore is a total deposit. So what happened? The bank is saying their average FD interest rate is 7%. But here for 100 crore deposits are totally there. But for that 10 crore interest has been paid. So that is basically 10%. But bank is saying their FD interest rate is 7%. So how can this happen? So for that purpose, then we need to ask the bank, bro, you are saying 7% is your average interest rate, and now for 100 crore deposits you have paid out almost total, for 100 crore deposits you have paid total 10 crore interest. How can that happen? So it is basically 10%, right? So bank will need to give us the explanation. Like that, there will be some reason they will give. So now we need to analyze the reason and say whether it is reasonable or not. That is what this point is about, that we have to assess the overall reasonableness of the amount by analyzing the ratio of interest paid out ratio with the total liability is this one. That is first point. Second is that auditor need to obtain from the bank an analysis of the various types of deposits. Different types of deposits will be there: savings deposit, fixed deposit, recurring deposits. All this we have to obtain a breakup from them. That is, we have to obtain an analysis of the various reports of the deposits outstanding at the end of each quarter. From that, from all these deposits, FD, savings, recurring, all these things, we need to calculate a weighted average interest rate. We will calculate a WACC, weighted average interest rate we will calculate, and then compare this rate with the actual average rate paid. What is a weighted average interest rate? You don't need to look at the practical side, just understand, compare weighted average interest rate with the actual interest rate. Simple. So first point, we need to check the reasonableness of the interest paid. For that, we will take the ratio of interest rate to deposits and see whether it is reasonable. Second case, you have to compare weighted average interest rate with the actual average interest rate. Simple. And see whether any difference is there. Weighted average interest rate is coming to 10% and actual is only 7%. So it's a very big difference. 3 big differences there. If difference is material, ask the bank. If small differences, okay, no problem. Like that. Then auditor should compare the average rate of interest paid on the relevant deposits of the previous year. Current year interest with the previous year interest, just compare and see each account wise. Then he need to analyze a month-on-month cost analysis document and reasons, and document the reasons for the variances if anything is there. Cost analysis, like interest analysis, you can check. So these are the ways you need to audit the interest. So 3 points you can write from here. Then this 1 point alone you need to learn this much. So when a question comes, that 3 points plus this point also you can add. Auditor should test check the basis on a test check basis. On a test check basis, auditor need to verify the calculation of interest and need to ensure that interest has been provided for all the deposits, all the FDs and the things. Bank has given interest. There is no deposits in which bank has not missed interest. Like that, or bank has missed an interest. Auditor has to check that. Interest rates are in accordance with the bank's internal regulations and RBI rules. Interest is paid only as per the bank's rules and RBI's rules. Interest on savings accounts are in accordance with the rules framed by the bank and RBI. This is on FD and this is on savings account also you have to check. Interest on inter-branch balance has been provided at rates prescribed by RBI. These things you have to write. Then these things are very easy. You just check it. That is, obtain an interest rate card and of various types of deposits and analyze interest. Like for savings deposit, 2% is interest. Recurring deposit, 5% is interest. Other things, FDs 8% is interest. Like that interest rate card you will get where it is written. So take that for all the deposits and analyze it. So all these things are very simple. Then examine the completeness that the interest has been accrued for all the things. Very easy. Then next is operating expenses. How will you audit the operating expenses? Very easy. Descriptive question it can come. Just study and keep the 4 points. Memorization. Study and evaluate the system of internal control relating to expenses. That is operating expenses. For running the bank may need some expenses, right? To pay the wages, to pay the electricity bill, all these operating expenses. So see the system of internal control relating to expenses, including what is the authorization procedure. If bank need to spend 50,000 to buy an AC, or AC is not operating, so buy something. Bank need to buy 50,000, something like operating things for the thing, for the bank. How that authorization procedure is there in the bank, like who authorizes that? Does the bank manager signature is needed, or the accountant itself can authorize? Like that you have to check here. Then examine whether there are any divergent trends in respect of major items of expenses. Major operating expenses compared to the previous year and see whether there is a sudden increase or sudden decrease. That is divergent trend. Then perform substantive analytical procedure for expenses. That is compare with the comparison. Then verify expenses comparison, and like you know what is SA 520. If you don't know, wait for the video. Next week I'll upload a video on SA 520. This is the most critical video because SA 520 analytical procedures, I'm 100% sure 80% of CA Inter students don't know that. Even if you have attended classes, majority of the students I have seen in my Power Prep batch, which is happening next week, there are a lot of students coming in, previous Power Prep batches, they don't know what is 520. They have know all the theory, but they don't know what actually is substantive analytical. That takes a time to explain. I will explain it in the upcoming video. Stay connected for that. Then verify the expenses with reference to the supporting documents. All the expenses in electricity bill, show the bill. For electricity expenses, compare it with the supporting document. That is a bill. That is how you do this. Then provisions and contingencies, how will you audit? Very easy. Ensure that the compliances for various regulatory requirements for provisioning is done. Then obtaining an understanding of how the bank computes the provision, how the bank is putting provision. Are they following the correct provisioning requirements which we studied earlier? All those things. Then obtain a detailed breakup of the standard loans, NPAs, and agree the outstanding balance with the general ledger. Ask the bank, give me a breakup of all the loans, all the standard loans, all the NPA loans, all this, give a list of all those things. And I will compare it with the general ledger of the bank to look at the provision, or whether they have put the provision properly for NPA loans, and whether standard loans is 0.4%. It's not needed that much. You don't need to understand provision for this. Substandard, yes, you need to understand. Then examine the other, obtain the tax provision computation. Bank will have a tax provision computation. Ask the bank, give it to me from the bank, and verify the nature of items debited and credited to the P&L in that tax provision computation. Simple. Examine the other provisions for expenses. Via this, that is the circumstances warranting provisioning and adequacy of the same by discussing and obtaining explanation from bank manager. What are the circumstances in which you put provision? It's very simple. Other provision bank is putting for expenses. On what all situations bank is putting that. Discuss it with bank. Simple. So these two things, it's okay. It seems still important, but I have anyways discussed. Let's Anyways, we have touched upon all the major topics of this chapter, and I hope you liked this video. And I'm 100% sure we have touched on every complicated topics in this chapter in a very detailed way, like we do a normal revision under 2 hours, hopefully, I guess. So I believe you liked the video. If this video was helpful, you learned something, just write it in a comment box. Then give this video a thumbs up, obviously, and more of this kinds of crisp and detailed, basically detailed revision video in a crisp under 1 or 2 hour we are giving. I'm uploading in the upcoming weeks, so stay connected. All the tough topics for your Jan 26 will be discussed. All the important questions, expected questions, everything will be given. So don't worry. So see you guys tomorrow with another video. So if you want to see me again, stay connected and give this video a thumbs up. And obviously a hype up if possible. Bye.